I want to bring in our first guest. Joe Smith is joining as the Deputy Chief Investment Officer at CLS Investments. So, Joe, the question now is, once we have this confirmation from last week, I think our takeaway was that Powell is on board for the cuts. What are we looking at now?
So I think after last week's Federal Reserve commentary back to Congress, a lot of kind of what we're looking at this point is really going to be focused around both earnings as well as what we're likely to see in terms of developments on the trade front. So, I think for us, we're looking at things, the first half of the year has certainly been great for investors, with global equity markets up around 17%. Here in the U.S., we're up about roughly 20%. And I think, where we're likely to see going forward is more of a little bit of the markets taking a breather in order to reassess kind of what's likely to happen with the global outlook going forward.
So, unless somebody's got a crystal ball and knows when that, deal made tweet comes through from the president, trying to read the tea leaves has been a fool's errand so far in this whole process, Joe. So where does that leave us? Just kind of looking at the data, seeing China slow over the weekend, the GDP print maybe suggesting they need some bounce back, they need some kind of catalyst?
Yeah, so, I think for us, we see actually the trade deal probably being the most likely catalyst for the markets to start to move higher. Something that I think is important with that is, although the Federal Reserve is certainly going to provide a little bit more support when a cut does come through, hopefully later on this month. The biggest challenge is still going to be how the U.S. and China progresses towards a trade deal. We know some of that has kind of been a start and stop type of situation. Clearly, President Trump made the necessary effort to restart talks after the G20 with President Xi Jinping. But I do think, what we're likely to see is a little bit more of a slower path relative towards getting something done over the next couple months.
Okay, now as it pertains to the kind of leadership here, obviously the S&P has been beating the rest of the world year to date. It's up now 25%. We're at highs. Does that continue then on the back of this trade deal, or do we have this kind of price to perfection market where maybe some of the bullish tone shifts towards EM or shifts towards ex-US equities?
I think that's a really good question. And in fact, I think what we would likely see in our end is that, continued leadership out of the U.S., but then also more participation for international markets, especially in the emerging market space. I think, something that we as U.S. investors tend to forget is that when you think about kind of what's going on with technology companies and, the push towards artificial intelligence and things like that, it's really, more so a battle between the United States and China. And so, when you think about kind of, what's likely to happen with U.S. tech companies, I would not think to rule out, Chinese tech companies also participating as a part of that.
Joe, when you look at the performance kind of deeper in within the market sector-wise, there's been strength in utilities, there's been strength in some of the defensive stuff, along with, obviously, the tech story and the growth factor that's also done well year to date. It's kind of been an everything rally. Does that start to thin out? Where do you want to be if investors get a little bit more choosy going forward?
I think although a lot of folks have talked about tech as the place to be just simply because of the overall performance and run that it's had, we're really liking more the defensive segments of the market, especially in the way of real estate and healthcare. We're typically messaging to clients that now is the time to be more resilient when it comes to their portfolios, just given that we're starting to see more late cycle behavior associated with the markets. And so, when we think about real estate and healthcare, both are pockets of opportunity. Because of the fact that they represent a little bit more safety for investors. But I do think, when you factor in things like lower interest rates, which certainly is going to benefit the real estate market when it comes towards, homeowners thinking to refinance their mortgages or to think to take out home equity lines of credit to maybe, renovate their homes. Or even on the healthcare side, where you're really talking about more cash flow oriented type of companies outside of biotech, those are basically, from our vantage point, great places to not only park money for greater safety, but really, have the ability to withstand the event of a more likely downturn in the overall markets going forward.
Yeah. All right, Joe, a good setup for us. We're going to leave it there for now as we continue this conversation. Joe, really good stuff. Joining us, Chief Investment Officer at CLS Investments, Deputy Chief Investment Officer.